Everyone calls Australia the lucky country. But what happens when luck runs out? Mining now makes up over 60% of all goods exports, with iron ore alone worth $85 billion. Yet that windfall has fueled runaway house prices, hollowed out innovation, and left families drowning in debt. Why is Australia going broke? And what if the real danger isn't what you expect? Asha remembers the year her hometown in Western Australia changed almost overnight. She was 10, watching road trains loaded with red dust snake through the Pilbara, iron ore bound for the coast. That year, the state raked in billions from mining royalties, enough to resurface every road, build new schools, and still leave a surplus that dwarfed the budget of some countries. In 2025, iron ore alone brought in around 85 billion Australian dollars, making up more than a quarter of all resource and energy export earnings. At the height of the boom, regional mayors handed out checks for new swimming pools and skate parks, joking that the only thing more reliable than the sunrise was another ship sailing for China. But beneath the surface, the numbers told a story of remarkable concentration. Over 80% of that iron ore was shipped to a single buyer, China. Western Australia's budget grew so dependent on this trade that a small dip in Chinese steel demand could wipe out billions in public revenue. The mining giants, BHP, Rio Tinto, Fortescue, expanded operations year after year, their profits swelling with each new contract. The resource windfall shaped everything from local politics to national identity, fueling the idea that Australia was simply lucky, its prosperity guaranteed by geography and geology. Yet as the cash flooded in, questions about where it was going and what it was building lingered in the background. For every new sports complex or regional airport, there was a sense that easy money was making it harder to imagine a future built on anything else. The wealth was real, but so was the risk hiding in plain sight. Sydney's skyline glitters with the wealth of a $10 trillion property market, but the shine hides a deeper problem. Tax settings, especially negative gearing and the capital gains tax discount, have turned houses into investment vehicles rather than homes. Since 1999, investors have paid tax on just half their capital gains if they hold property for more than a year. Negative gearing lets them offset rental losses against other income, making speculation more attractive than backing new businesses or technology. The result? Capital rushes into existing houses, driving prices far beyond reach for ordinary buyers. In Sydney, the median home now costs 13 times the median income, among the highest ratios in the developed world. For many Australians, like Asha's older brother, the path to security no longer means starting a business or inventing something new. It means buying a second property. Investor loans routinely outpace lending to small business. Construction, now 7 to 8% of GDP, booms on the back of new apartment towers, but the real economy underneath is hollowing out. Money that could have built factories, funded research, or seeded new industries sits locked in bricks and land titles. Australia spends just 1.8% of its GDP on research and development, well below the OECD average of 2.7%. As easy returns from property crowd out innovation, the country's capacity to create and compete slips further. For engineers, scientists, and entrepreneurs, the message is clear. The system rewards speculation, not invention. When Asha's family faced their first variable rate mortgage shock, it wasn't just a personal crisis. It was a symptom of a country that has bet its future on rising house prices instead of new ideas. Asha's graduation photo sits in a frame on her parents' sideboard, but her LinkedIn profile now lists an office in Singapore. She's one of tens of thousands of skilled Australians who have packed up for better prospects overseas. In 2023 and 2024, official data shows a net outflow of up to 40,000 Australian citizens, most of them highly qualified, many in medicine, engineering, and technology. Recruiters in London and San Francisco pitch salaries that seem out of reach at home. UK hospitals offer doctors up to 60% more than the going rate in Sydney, while a software engineer in California can earn double or even triple the Australian average. These aren't just numbers on a spreadsheet. Each departure leaves a gap that's hard to fill. When Asha's cohort left, her old firm struggled to replace them. The story repeats across the country. Regional hospitals short on doctors, startups losing coders, universities watching their brightest researchers move abroad. Most don't come back. For Australia, it means the loss isn't just talent, but the very people needed to build new industries and spark innovation. The result is a quiet, steady erosion of capability that no amount of mineral wealth can buy back. Asha's grocery bill has doubled in just a few years, and she's learned to stretch every dollar. With household debt now at 185% of disposable income, one of the highest rates in the world, even small price hikes force hard choices. Each week, more families line up outside the local food bank, some for the first time. The mayor, once able to promise new parks and libraries, now faces a backlog of stalled infrastructure projects. Across the country, the gap between what communities need and what governments can deliver has ballooned to as much as $800 billion. Public transport groans under the weight of new arrivals, while roads and water systems age faster than they're repaired. The national broadband network, sold as a leap into the digital future, became a cautionary tale of political meddling. $60 billion spent, yet many suburbs still lag behind global standards for speed and reliability. Coles and Woolworths, controlling over 70% of the supermarket market, set prices with little real competition. In this environment, even a small rise in interest rates or a spike in fuel costs can tip families from just managing into crisis. For Asha, every budget cut, every skipped meal or delayed bill echoes a larger story, where the promise of prosperity has given way to daily trade-offs and shrinking opportunity. Asha's phone lit up with warnings as rain hammered her street. The river behind her house, dry for years, surged over its banks and swallowed the road. That summer, floods swept through her region, leaving behind a trail of ruined homes and shuttered businesses. Across Australia, climate disasters have cost $38 billion in just 5 years, and insurance premiums in high-risk areas have doubled or vanished altogether. Some families now face the reality of being uninsurable, forced to rebuild from their own savings or walk away. At the same time, the country's aging population is stretching the social safety net to breaking point. 17% of Australians are now over 65, and the age pension already costs $58 billion a year. More than 110,000 people sit on wait lists for home care packages, while hospitals and aged care homes fill beyond capacity. Fertility rates have slipped to just 1.6 births per woman, well below what's needed to replace the population. With fewer workers supporting more retirees and climate shocks draining public funds, the pressure mounts from all sides. For Asha's parents, the dream of a secure retirement feels less certain with each passing year. The bills keep coming, but the resources to pay them are running thin. China now buys more than $170 billion worth of Australian exports each year, making it by far the country's largest trading partner. But this relationship has proven fragile. In 2020, a single diplomatic dispute triggered sweeping bans and tariffs on coal, barley, and wine, wiping out $20 billion in sales almost overnight. For Western Australia, whose budget depends on royalties from iron ore shipped almost exclusively to Chinese steel mills, even a minor slowdown in Beijing can send shockwaves through schools, hospitals, and public services. The lesson is clear. Australia's prosperity is tied to decisions made in distant boardrooms and ministries. Yet while the risks have grown, the ability to respond has shrunk. Parliament cycles through leaders every 3 years, making long-term planning almost impossible. Major reforms, whether in tax, industry, or education, are routinely shelved in favor of short-term fixes. As government debt approaches $1 trillion, the room to maneuver narrows further. Instead of building resilience, Australia is caught in a holding pattern, hoping that commodity prices and global demand will hold steady. For Asha, weighing her next move, the sense of drift is unmistakable. The future feels less like a matter of policy and more like a gamble on forces beyond anyone's control. In 2023, over 140,000 Australians, many highly skilled, left the country, reflecting a system under pressure from within and without. The facts are unambiguous. 60% of all goods exports rely on mining. Household debt stands at 185% of disposable income, and Australia's productivity growth lags behind the OECD average. Infrastructure shortfalls now top $600 billion, while $38 billion in climate disaster costs have hit in just 5 years. Despite these numbers, key questions remain. Will political leaders break through policy gridlock? Can Australia reduce its reliance on volatile commodity markets and a single trading partner? The evidence shows that without bold, structural reform, living standards will continue to erode. As government debt nears $1 trillion and an aging population increases fiscal pressure, the window for change is closing fast. On the current trajectory, Australia's status as the lucky country is no longer assured.